Good afternoon, everybody, and welcome to the last Oktoberfest bull session for 2021. My name is Mark Robertson. I'm joined here by Ken Kabula, my dear friend to the north, where it's crispy and he's rewiring stuff at his house. Good afternoon, Ken.
Good afternoon, Mark. I've been assured that my internet is going to hold steady as long as this session takes. So
okay, are you knocking on wood?
They're not going to play around with it. Well, these guys are pretty capable, so when they tell me something, I really believe them. So we'll see.
Just make sure everything is still humming for Saturday morning.
Yep.
And we also have a roundtable tonight, so it's interesting times. Now, Kim is probably going to be detained and off on a mission this afternoon, but we are joined by Sean Mace from Pennsylvania. Good afternoon, Sean.
Hello, everybody.
All right, so let's go ahead and get underway. I'm not going to ask you about lederhosen, Sean, but Oktoberfest is waning a bit. But
yeah, just a little bit, but a bit too cold right now for all the lederhosen. It's 57 out right now.
Just have to double down on the leggings.
You got to get those stockings stuffed.
All right, so let's go ahead. We're going to talk about, again, Red October. The red is basically in honor of the Red Rabbits, and the Red Rabbits are taking over the top of our page. Ken just thinks it's my infatuation with animals in general, but there's a method to our madness. This is the time of year, and we've been demonstrating that at the last several bull sessions, though, that we kind of sniff around and check a bunch of different pockets for ideas to invest in, and we've been having a pretty good time doing that. We're going to basically complete that this afternoon, and at least our first cut through all of our favorite sources of ideas. For the rest of the week, we will continue to round out that list of 20 plus or minus stocks for what we call the best small companies. Maybe we'll table that for right now, but we've been kind of beating up on the word small as to whether or not that is descriptive enough. We'll probably talk about that on Saturday, but some good, clean fun. We will check in with the Motley Fool as a source of ideas. That is Kathy Wood from Ark Investments there. And the Morningstar is just simply an acknowledgement that it's a pretty good place to go and look and see what people who seem to know what they're doing, like Kathy, are invested in. And there's our cover slide from this Saturday's session. If you know somebody that's interested in attending that live, I think we're probably going to have our first sellout. Limited seats available. So how's that, Ken?
That works fine. If I don't know, well, I can't do anything to back it up because it's on a different number, isn't it? Yeah. So we get to 101 and we're done.
Yeah. So if we sell out, we do record the session, and that's what people will have to turn to if I can't figure out a way to modify that between now and the weekend. Well, let's go ahead and get underway. Again, here's your reminder. This is our standard boilerplate that no investment whatsoever recommendation is intended. This is about education. The modern investment club movement is entering its 9th decade. Going back to the early days in Detroit, you can actually trace back investment clubs to a few years before that. But what this is all about is our interpretation and deployment of those principles, philosophies, analytical methods, and frankly, the opportunity to gather with friends and share ideas, whether that's around the kitchen table or the hearth with a glass of adult beverages or the beverages of your choice. Some of it is done online these days, and that is what this is all about, simply demonstrating those techniques. You'll hear opinions from us. Please do your own homework before making an investment decision. And if we own something, we do try to remember to acknowledge and share that with the audience. Tonight's roundtable will start at 8:30 Eastern Time. If you'd like to be on a reminder list, or you know somebody who would like to, for future roundtables, that's our monthly webcast, which is hovering at about 18.5% for a rate of return since July 2010. And we've had a pretty good run. few bumpy months and a few bumpy selections here over the last few months, but a really good run. If you'd like to be added to that reminder list, send an email to nkavula1@comcast.net. Natalie will add you to the reminder list. She only sends out a couple, 1 or 2 per month, and certainly will not bother you and inundate your email box. If you'd like copies of the slides, or if you have a follow-up question or suggestions for future topics, please send me an email at markr@manifestinvesting.com. Anything we need to add to that for now, Ken?
No, I think it is working out just fine. Natalie is starting to register a lot of folks and adding people to our guest list for our conference coming up in November, Mark.
We're seeing those come across the transom for sure. Good stuff. All right, here's just our quick reminder of what is in the bullpen, our queue of topics to be covered. Today we're going to jump on again that last session with respect to the preparations and feverish screening and notepad scratching that's going on that Ken and I are doing for Saturday morning. How you holding up there, Ken?
Well,
I mean, what do you got?
Making
like
a really I'm making a real valid attempt to make the arithmetic work out in some of these cases here, Mark. I still haven't decided that the arithmetic is working out correctly in some of these cases, but I guess I'll have to sit down and actually look at the data before I say that somebody's off in the wild blue.
You mean trust but verify, right?
But really verify, yeah.
Really verify. Well, yeah, there's no doubt. I mean, we had a brief conversation before opening the session up, and there are stocks out there that the analysts are simply quite exuberant, and they could be right. They go through exuberance and pessimism like you wouldn't believe, and sometimes the numbers that, because we do not condition those numbers at all, we simply use what we are presented, and sometimes they get, well, you already said it, worthy of head scratching. So,
but I'm gonna keep most of my powder dry, but I challenge you to find very many companies that can double their net profit margins in the next 4 or 5 years. So
don't challenge me. I'll be distracted for the rest of the day.
You know, that sounds like a challenge Kathy Wood would take on.
Yeah.
Well, I'm going to leave it to her. Okay.
I'm looking forward to seeing her Groundhog numbers after Tesla's jump here.
Yeah, there you go. Yeah, she's probably going to have she's moving up the list. All right, so we're going to spend some time with Motley Fool, with Kathy Wood. We have a couple other mutual funds that we'll take a look at. We'll probably briefly talk about the real money demonstration portfolios that I've been exploring at M1 Financial. And then again, those other topics are for another day, but we will ultimately get to them. All right, here's one of our slides, one of our favorite graphics. What are we down to, Ken? 3.5 days of trading before the end of this?
Just about, yeah, less than that even now.
So yeah, we're pretty close to 3 days. I think we might, here, I'm knocking on wood, we might make it. We are hovering near 50% for the 20 companies that we selected 1 year ago on Halloween. And you can see that the multi-year total of the years that are shown on this graphic are the ones where Ken and I basically adopted what Forbes was doing for a long time and converted it to a really simple thought. Why not do this like, we typically do it at Better Investing and Manifest Investing, and demand excellent companies that are on sale. And it's working out pretty well for us so far, Ken.
So far, I'm gonna take a walk down my educational experience, Mark. I had quite a problem logically when the school systems around us went to advanced grade point challenges for grades and allowed you to come up with a better than perfect grade point average for your time in high school. And so I got my school board to write a rule into our set of rules that anything above perfect was a tie. I'm thinking that's the way this year should be characterized as well. anything above 40% is a tie. I'm glad that we're beating them, but this has been a phenomenal year for the Wilshire 5000. So
Yeah, and that red bar on the far right is spectacular, but the real story here is back in 2015 and 2016 when the red bars just completely obliterated the blue bars.
exactly.
Different.
And that's when the investing style and the discipline that you have really makes a difference. It's okay to beat a phenomenal year or lose a little bit in a phenomenal year, but if you can beat on a bad year, really beat on a bad year, then you've put together something that improves your portfolio immeasurably, and that's where I'd like folks to focus. I mean, even in 2018, our red bar is twice the size of the blue bar. We're approaching that again in 2020, where it's probably 2/3 again as good as the blue bars. So,
yeah, and this is past performance, and there are no guarantees. Everybody bold that and underline it. But Sean, you get a little bit of this. It goes a long ways in a child's long-term growth account.
Oh yeah, no, I was just thrilled with looking at a 7 or 8% return annually for a growth account. If you follow the S&P 500, to follow something like this, amazing.
Yeah,
and
go ahead, Ken.
And we're putting those companies out there, and we're showing the world that what our picks are, and then we're sticking by them. We're not conveniently forgetting about them 3 months in or 6 months in, like a lot of the contests that go on. We follow the whole thing and report on what it does. For 7 years, the reporting has been favorable in our favor, but it's very transparent, and that's what I like about the kind of investing we're doing.
Well, I will.
And you definitely hit the. Go ahead, Mark. Oh, you definitely hit the nail on the head there, Ken, when you mentioned like this is our past performance stuff, but and it's easy to look back at the numbers and be proud of them. But during those times, like it took a lot of discipline to follow through with stuff and stick with it, to not sell when you might have wanted to sell, or to buy something or not buy something when you're like, this is meeting all the metrics, but it's about having that discipline to buy or sell that. And there's a lot of hard work and sweat equity that went into this.
I want to record that, Mark, and play that back to you this coming Saturday, okay?
Oh, I didn't mean to give him ammo there, Mark. I'm sorry.
Yeah, Sean, don't give him any more ammunition. No, but one last comment. We're spending too much time on this slide as it is, but one last comment. I was with a room full of professional investors this morning and talking about this, and they were just impressed, would be putting it mildly. And just the fact that you can go back and look at every single decision and it's all documented is really pretty cool. Let's go ahead and keep pressing on here. Here's just a quick reminder that if you haven't already done it, we encourage you to go back and look at our bull sessions from a couple weeks ago when we talked about this notion of, might there be a period during the life cycle of companies, and it's way more than might. There is a period during the life cycle of companies when PE ratios just simply don't apply. That doesn't mean you can't analyze them. You just have to do it differently. And just think about it differently. Now, most of us just love to live in that zone shown by the blue bar, the blue core holdings, but it can be very, very profitable to find a promising, emerging, I'm trying not to use the word SMALL, because Ken and I talked about
growing,
that.
Mark.
Faster growing. I came up with some others synonyms like prodigious or wonderkind and things like that. We need to work on that SMALL word, because it doesn't.
How about we're just rabbit size?
Rabbits.
Rabbit size.
Good stuff. All right. One last graphic just to drive the point home, and this is for the people out there that say, do I really want to do it? Is it worth the time? You're looking at the Wilshire 5000 on the lower part. That's the blue graphic. The red is the value line arithmetic average. And that one is equally weighted. And the bottom one is dominated by actually a fairly small group of about 20 very large capitalization companies like Microsoft, Johnson & Johnson, etc. So the point is the rabbits are what are causing that red line to do what it's doing, the red rabbits. And you can see that that has been pretty significant over the last couple of decades. All right, here's just a quick reminder and invitation to join us on Saturday morning. I think we set it up for 10:30 Eastern time. Is that correct, Ken?
Yep.
And we're going to just briefly review our 2021 results and give the 20 selections that we'll be going forward with in our Halloween group for the next year. All right. Here's just a quick, and this is a work in progress, a rough cut, first cut. This is kind of the list that Ken and I have started with. Some of these companies have already been crossed off for a variety of reasons. I'll let Ken cover that, but you're basically looking at a list of companies that are covered at Manifest Investing that are growing greater than 12%, that have a quality rating, quality ranking greater than 60, which means they're in the good and excellent company group. And then we also went hunting for companies, and that's what it's sorted by, double-digit projected return on value, because that one's a little bit insulated from the effects of PE for some of these smaller companies. And we basically look at the projected annual return and the projected return on value. It's kind of in harmony. Your thoughts on this, Ken?
Well, we're doing as good an effort as we can to mimic the list that used to come from Forbes, and to keep the list of stocks that we're choosing of the same general flavor, so that we can compare them year to year to year. If we get too far away from our most basic definitions, then the lists no longer become comparable as you look back on them. And I think it's important that since we started with a certain style, that we try to keep a lot of that style, in our point of view as we pick the companies. You can see for yourself, if you go down that trailing 12-month trend to sales there, that some of these companies are too big to really be considered the classic small company that Forbes began with 15, 20 years ago. At that point, they were talking about companies with less than $1 billion in revenue. And, I think with inflation and with consolidation in some of the major industries, I think we might be able to stretch our upper limit now to a number larger than $1 billion. But I'm not willing to stretch it. And Mark has pointed out Lam Research at $12 billion. I'm not willing to stretch it that far, or even Skyworks at $4.2 billion.
Oh, you keep
I think it's
Skyworks.
probably, I know, but I think it's just probably too big. It's a great company, Mark. I really like it, but I just think it's too big for this kind of list. And I want to preserve the integrity of the list itself.
Yeah, it's certainly on the fence. Well,
Yeah.
Speaking of the integrity of the list, now, you guys out there in the audience, you know that Ken has rarely ever met a regional bank that he didn't like. So when we sat down to do this, I think he brought 42 names of regional banks. So come Saturday, I'm just going to stand back, and he's going to have a cage match between all the regional banks, because I think we can only really accept one or two, maybe. I don't know. We haven't made up our mind yet.
Well, and it's important to note that column that we've been referring to, the sales column there, is different when you're looking at asset-based companies. Those numbers that you're looking at right there are measuring book value. They're not measuring revenues. And I'm kind of convinced in my own mind that total assets are probably a better measure of the size of a bank than book value. So I'll be kind of looking at the total assets that these banks have that we've considered, and then I'm going to take a really deep look at the return on average assets that the banks are putting forward, and not only looking for a high number in the most recent year, but looking for a trend that shows that number either stabilizing at a nice high number or generally moving towards that number on a consistent basis. So there's some great banks on this list right here. If you want one to study before Saturday, pick out Southern Missouri Bancorp, SMBC, and do a deep dive into that. It's a fairly small bank, and I think you'll be pleasantly surprised at a lot of the metrics that are going on in that bank.
Yeah, they definitely been delivering on performance. The problem I have is it was $36 a couple weeks ago, and now it's 48. So that's really
too bad.
Yeah, I mean, gosh darn it. I mean,
yeah.
if we could,
that was that was pretty true of a lot of the banking industry in the last month, though, Mark. This was a great month. October was a great month for a lot of banks in your portfolio.
Yeah, I still think that the growth rate is probably the most important characteristic of them all when it comes to this. So,
absolutely, absolutely.
All right, here's a reminder of our favorite sources, and we've covered some of these here in previous sessions. If you're joining us here for the first time in a while, if you go back over the last few weeks at YouTube, you can see that we have covered, again, the Better Investing small company screen in the preset or predefined screen at Better Investing. We talked briefly about the Forbes most recent best small list. The list that I found very enchanting, Sean and I covered the 100 fastest growing companies from Fortune. That's an enchanting list, and certainly rhymes with the way we think. Now, some of the larger companies make it into that list, and that's okay for what we're doing. That led us to those the Financial Times fastest growing companies, which gave us a couple to scratch our head over. Microcap Club actually led us to Brian Feraldi in the session from a couple of weeks ago, and social media has delivered a few stocks along the way. So we will continue down the path here today of taking a look at some funds and some people like the Motley Fools as we continue to, again, scan for ideas to study as we narrow down the list to our final 20.
I will say, Mark, that it's important to take a look at some of these SPAC-based companies that have entered the market in the last couple of years in great numbers. There's so many of them out there right now, and it's important for the investor to become educated to the point where they understand that's a whole different model, and those aren't necessarily going to be small, fast-growing companies when you're looking at these SPAC things that are occurring.
All right, so let's go ahead and keep pressing on. Let's spend a few moments with Tom and David Gardner. That's David on the left, Tom on the right. Again, I had the pleasure of working with these guys directly as they contributed columns to Better Investing magazine many years ago. Back when they were just getting started, they've been speakers at a number of national conventions, and they tend to think a lot like we do, especially Tom. And David he thinks more like Hugh and Tim and some of the more adventuresome investors that are out there. That's what we mean by the rule breaker note up at the top. And David had some fairly spectacular performance. We chronicled that in that article that's in the blue there, First Break the Rules. And you can go back and take a look at that. And that's pretty good guidance on how to think about a Tesla or an Amazon. And if you have a few of the other companies that are, a little bit out of the rule book for many of us, very early stage in some cases, that sort of thing. So you're invited to do that. And then I've been kind of neglectful when it comes to Tom. And I didn't realize that he basically has been knocking it absolutely out of the park for the last 3 years. his team, they kind of started off as rule makers, rule followers, but people who basically are very prominent and controlling in a certain sector or industry. And that's basically the way they got their start. And the team continues to look for dominating, innovative companies. And the return speaks for itself. It's off the charts. I don't know if he's caught up to David yet, but he's certainly on the right path. And the stocks that you see on the screen there are just a sample or a taste of Tom's team and what they've done here over the last few years. Pretty impressive. And I had no idea that he was going into technology quite as much as he is. Note the Tesla timing and note the Tesla price. That's got to make you smile, Sean.
Ear to ear.
It's important, Mark, also to note that he got into some of these things quite early. And while that's an impressive annualized return for Zoom, for example, it's nowhere near the high for Zoom. That this list contains some real volatile kinds of things in the last couple of years as well.
Mm-hmm. Yeah, and of course, Upstart has been in the news as a meme stock here lately, so that kind of shot it up to the top of the list. But some pretty good thinking, and people are scratching their heads over what Tom and Dave are going to do next or what they're doing now and that sort of stuff. But I've been very impressed by a lot of the stuff that I'm seeing as I dig in a little bit deeper. All right. One of the things that I thought I would do just to show, why something like this captures our attention. Now, I know this is a busy slide, but what you want to look at here is this is going back to when we started really doing our stuff after the Forbes list was kind of abandoned, and going all the way back to 2006, 2007. What I did is I just grabbed the selections made closest to Halloween each year, and I clocked it in and clocked it out 1 year later. So that's what you're seeing on those added and removed sites. You can see that a year ago, this Fiverr International, which frankly I don't know that much about the company. I know it's been showing up in a bunch of areas, so it's probably worth digging in and understanding. It's been a multiple time recommendation at the Fool, and of course Autodesk is the computer aided design software that it's known by architects and engineers worldwide. And those two companies haven't fared really well. But Ken said he would threaten me if I considered 22% for an annualized return to be a loss. And I agree with him on that. That's not a loss, but it's not an ultimate win either. But looking down that list, you can see some pretty good performance. Note that half of them actually come in with a positive relative return, so they beat the market over the time frame. But check out this number. And again, the reason that this slide is in front of you is it's just simply to defend, as if it needs a defense, defend that, yeah, I care what these guys are chewing on around Halloween. And are they tricks or are they treats? And I'm not going to tell you their picks from their subscription newsletter right now, but they're right. I mean, we want to make sure that those are being tracked at Manifest, and that's what we do. Anything jump off the page here for you, Ken?
No, just keep in mind you'll see the same name on there occasionally more than once, and that just means it was in and out at two different time periods. Schwab, for example, had a really good year up near the top of the list and a not so good year near the bottom of the list.
Yep, this one here and then this one here, not quite so good. I was surprised to see that the timing on Love didn't work out very well, because we certainly caught that one back over the years. All right. And then another thing that I was reminded of that I got to confess, I have not spent enough time thinking about this with respect to individual investments. And this can be a real tiebreaker, especially when you're dealing in the types of companies that we'll be talking about on Saturday. And all I've included here is a look at insider holdings and institutional. We call them rhinos. The rhino holdings is the institutional holdings as percent of outstanding shares. And the ones that are in purple are simply because they had to be pulled from someplace other than Y charts. So it's sourced, in this case, from Yahoo. But David Gardner, in the Hidden Gems newsletter, pointed out that he just loves to find a company that has a decent insider holding stake, without being too dominating. You can that number can actually run too high, can get too high where they have too much control, and sometimes don't always make the best decisions on behalf of their external shareholders. So you want that to be in perhaps 5 to 10% range. Was one of his key factors for the Hidden Gems newsletter that we used to feature at Better Investing. And the second column there, the Rhino Holdings, right now the average institutional stake for a company is approximately 82%. And for some of these younger, earlier stage evolving companies, those numbers can be a whole lot lower. I can't explain Luckin Coffee. That's a company on the ropes, a Chinese coffee company on the ropes. But Tom's premise, and I think it's one that if you really subjected it to some solid analysis, that it just makes sense to have one where the ownership, they have a stake in the game, they have a decent insider percentage, but hasn't been discovered. Like look at Appian, in the 60% range for institutional holdings. That just simply means there's room for more discovery. This lemonade down here. Again, room for being discovered. Any thoughts on this?
Susie Artsberger has done some programs, Mark, on this institutional holdings number, and she's made the point that no matter how accurate it might be in data collection, it's still one of the most inaccurate numbers that exists in investing, because by the time the data is collected, the number has changed, and a lot of times it's changed severely in one direction or another. The stocks, the shares fly in and out of accounts so quickly sometimes that getting a good read on how much is actually being held by institutions is virtually impossible for the data collection agencies, hence the plus 100 numbers in a couple of these entries.
Yeah, and there's double counting that goes on. Yeah, you want to take these. You certainly don't want to get trapped in the granularity of these numbers. I'll just put it that way.
Absolutely, they're just not very exact.
Right. But again, coming back to Tom Gardner's premise with Hidden Gems, you can find one that's held by the people who pull into the parking places in the morning to work at your company. It's good when they own a stake in the company, and at the same time, room for discovery. Like I can remember Massimo is one, watching that go from a 20% institutional stake, and it was discovered, and the institutions basically piled on, and that was good for us. All right.
It's kind of like the quality number, Mark, that when I see a quality of 92 and a quality of 90, I'm basically calling that a draw. But when I see a quality of 92 and a quality of 62, I do know there's a real difference between those two companies.
Yep. Crayons. I guess I could put some crayons on there for you. Big fat crayons if we can. All right. Let's take a quick look at, this is one of my favorite mutual funds. It's actually an exchange traded fund, ETF. The ticker symbol is MF, that's Motley Fool, and MS, that stands for small companies. So MS. And it's run by a guy by the name of Bill Mann. You can see Bill there on the upper left. Bill is good. He's smart. He thinks like us. And as a source of ideas, absolutely. These are the top 25 current holdings. Nothing really jumped out and grabbed me except maybe this one. And I actually put this in a pile to study for the next time Ken and I get together. PTCT. And what grabs me is just simply the fact that it's got a 20% growth rate. So plus or minus, that's still pretty good. And the projected annual return and the projected return on value are both double digits. And it could be a company with room for improvement and perhaps room for discovery, all that kind of stuff. So again, using a source like Morningstar. We'll show you the Morningstar version of this in a minute. Basically taking somebody like Bill. By the way, Bill's fund ranks in the top 10 of all-time performers since inception of his fund. So it's among the performance leaders, and again, a source of potential ideas when he becomes interested in one of these type of stocks. Anything grab you here, Ken?
Well, just the name Mesa Labs at the bottom of the list grabs me, Mark. That's a blast from the past. I wonder if that's an increasing holding or if that's a holding moving down to nothing.
Yeah, he's had it for a while, so I suspect it's
Yes,
probably.
he has.
Mm-hmm.
Yeah.
Notice that alarm.com is up here near the top. This is the Taser company, which is in direct competition with Ken's selection for tonight's roundtable.
Oh, no, not direct competition at all, Mark.
No, really?
No, two very different tools used in very different circumstances.
Okay, all right, I'll buy that.
Yeah.
This is a good study, by the way. I don't know if it's attractive right now, but Goosehead, that's an insurance company, promising, innovative insurance company. So there are some companies on here that kind of reach out and grab me a little bit. I've always loved Trex. Actually brought it to the Better Investing Stock to Study years ago. And
Globus is a good one too, Mark. GMed.
Yeah, GMed. So again, they tend to these guys at the Fool tend to think like us, or very similarly, and you can extract some ideas along the way. I'm sure we're missing a good one there or two. All right, let's switch gears and talk about Kathy Wood and Ark Investments. This happens to be another exchange-traded fund. It's the Ark Innovation Fund. Many people follow this fairly closely at Manifest. Len Douglas is in the audience. I think Len checks in on nightly to see what Kathy's been up to. They actually publish their transactions every night. So anytime you're looking at it as a fund, you know exactly what's in it. So you can track it just like you would track a personal portfolio or an investment club. And key feature here is growth. It's innovation, it's growth. Some of these companies have been pretty red hot. Some of them are, still in that emerging mode or that evolving mode. So you have to factor that in also. But we just want to make sure that we are covering all 25 of these and watch for the opportunities to study and consider stewardship. Any thoughts, Ken?
Well, there's some very interesting names on there. Yeah, I'm just not sure that this is. I would study each one of these with a deep dive before I moved into any of them.
Oh, we always do deep dives.
Yeah, well, I would do a really deep dive in a lot of these.
You mean like you want the metal detector for the minefield?
Yeah, something like that. Yeah.
Okay. Well, here I'll give you.
I wonder if I also wonder, Mark, if she's going to have any kind of a self-imposed discipline about how large is large in a portfolio. Tesla is now, occupying 10% of her portfolio, and that's getting to be the size where it's going to kind of control the performance, the overall performance, if it gets much bigger. And I'm wondering if she will begin to lighten up on anything like that, especially with a par value at the negative right now.
Yeah. Well, we shall.
I'm looking at these proved numbers here for the Nvta, Nvta Corporation.
Yeah, that's definitely one that could be worth taking a look at. I'm pretty sure that's a biotech. The one that jumps off the page at me, and we've talked about this one, it's a company out of Madison, Wisconsin. I actually have a niece who works there as a forensic scientist. So I am a little biased.
Are we back to the toilet seat again, Mark?
I wasn't going to bring it up, Ken, but you just did. This is the company behind the actual product is the colorectal kits that you can actually home administer. And I do not have personal experience with the kits. I do have personal experience with going to the clinic for certain tests that people over the age of 55 take. And they're trying to eliminate those tests, and I'm all for them eliminating those tests. And I am, in case somebody's really worried about me, I am talking about a colonoscopy. Fairly routine check. All right. Enough of that.
Dwight has chimed in and wanted to know if any of us are following the new investment club that Jim Cramer is touting on the CNBC channel, where he sends you a couple daily emails, at least one, sometimes two or three, about what's happening in the markets. I signed up for it, Dwight, and I've been reading the emails for the last week or 10 days. I find them kind of frantic. An awful lot of information distilled to a very few words and then jammed into a very small piece of paper or a very small screen. So the jury's out as far as I'm concerned about whether I'm going to continue, but I'm not getting a lot of usable action at the moment. It seems that the investment club is doing a lot more suggesting of trading than Jim Cramer ever did. So I'll have to watch it for another couple of weeks and see if I can draw some final conclusions.
Well, I'm not familiar with the specifics of what he's up to these days. He's been trying to get a club of some sort going for a couple of decades, really. But what I would point out, now I'll turn this to a positive spin, and Ken, you remember this vividly. The COVID portfolio that he put together over a year ago.
Spot on.
Yeah, that thing was superlative in terms of the calling out opportunity, and I would just acknowledge that. And basically give whatever he's up to a fair day in the sun, I guess.
Well, what he's done, Mark, is he's taken the management of his charitable trust completely away from the company that had been managing it and publicizing what it was doing. And he's put it now into this club where he's now channeling all the announcements about buys and sells from that charitable trust through this club. So you're getting some information on actual holdings of his that he's managing. But he also feels obligated to give you a rundown on all the people that presented earnings in a particular day. And some days that's a lot of companies. And the information is coming so quickly and it's in such a distilled form that I'm having trouble keeping it separated in my head even. That's
it sounds like
I'm really old, you know.
It sounds like he's took his entire show, Mad Money, and just condensed it to one page.
Sometimes, yeah, sometimes.
Yeah, some people have been doing that for years, and frankly, I mean, we have enough sources of earnings information, and probably not enough sources that actually tell you when it's actually material. Or
I'll tell you, it's the easiest thing in the world to join and see if you like it, folks. Just point your camera on your phone at the code on the screen, on the CNBC screen, and it'll take you right to the website. And all you have to do is give him your email address, and you're started. It starts immediately. So it's very easy to join. There's no dues. There's no you don't have to do anything except read what you want to read and hit the delete key on the stuff you don't want to read.
Well, I'm glad Dwight brought this up. I'll have to take a look now. Ken, have you lost your TV remote again?
No. Why?
Oh, is your TV stuck on CNBC again?
No, it's not, Mark.
All right, let's move on.
I'm just storing all these up for Saturday, Mark. I'll tell you.
All
okay?
right, yeah, you're gonna come back and get me. All right, for those of you that aren't familiar with Insider Monkey, here's a quick look at the holdings of the Ark Investment. Now, this is not just the Innovation Fund. I think it coagulates all of them into one place, I think. Don't hold me to that. But again, as Ken mentioned, really like the treatment of the activity from the SEC filings, this notion of calling out the new positions as something to dig into. just a good resource for checking into an idea, especially catching a potentially emerging company from top to bottom. So on insidermonkey.com, you can access it through that. This is free. It's a free site, and actually access the activity at a place like this. And they actually have some other features here. I just included this one for its demonstration value. What are her top favorite 15 small cap picks? And here's number 5. Again, just to give you a quick look at something that is available out there that's at your fingertips. And again, you can rest assured that all 15 will be in manifest coverage, and we will attempt to be as vigilant as we possibly can about them. All right, let's see. What else have we got? Okay, just a few minutes talking about one of our other favorite sources. And this one's kind of cool because this one is, Brown Capital, small company. It's an actual mutual fund. It's closed to new investors. The ticker symbol is right here. We've always, for many, many, many years, talked about it as a source of ideas. Looking at that list from top to bottom, you will recognize a number of community favorites for us, and they haven't been tremendously active. But the reason I bring this one up, and this is just a moment for diversification and thinking about, what drifting from diversification can do to you. These guys completely avoid financial sector stocks, and they have actually dropped down the performance list this year. While everybody else is zooming, anybody that has any financial stocks, especially Ken's regional banks, have done pretty well. Brown Capital has had one of its worst years in a very long time. In fact, they're down to 3 stars. From Morningstar.
They're only up 2.85% year to date, too. Wow.
Yeah. So, I mean, the lack of banks, along with a couple other, nasty moments for some of the stocks, they've paid a price for that. They call themselves completely agnostic when it comes to sectors, and they avoid the financial sector completely. And it's come with a price during this year. Now, other years, probably fine. The long-term track record is fine, but not as strong as it had been. And there was one company on here, Verisol, which that's intriguing. I believe that's the company that's doing, it's a biotech, but they're working on solutions for knee damage, cartilage damage, that kind of stuff. And this is all 40 holdings. So from top to bottom, you can see that there are some fairly new holdings. These were all added to coverage. Duck Creek was just added to coverage at Value Line. So you can see the 21s here. Want to make sure that we're looking in, because these guys have shown a real aptitude for identifying exciting, promising, newer, evolving companies.
I just went to a visual analysis of Vericel, Mark, because my eye pulled it off as suddenly gaining a lot of shares in this fund. Here's the poster child for moving into profitability. It's a great picture of what we're looking for when a company goes from being not profitable into just beginning to be profitable, and how it can really start to take off real quickly. If you folks have your SSG Plus available, you might want to take a look at VCEL, Mark.
VCEL, we can throw it up on Y charts, which is a mini stock selection guide, by the way. And look at the characteristics that Ken is talking about.
But it's been around for a long time, 9 or 10 years at least, and just has become profitable now in the last fiscal year and the first 2 quarters of this year.
Yeah, so this is that launchpad concept that we talk about with the St. Louis.
Absolutely.
Launchpad investing, and it can be a really rewarding area to be. You can see that the market has certainly noticed it here. But again, really nice revenue. That's what you're looking at for one of these evolving companies. And as Ken was saying, you basically have a breakthrough moment, kind of a tipping point for the company. And then just for kicks, let's take a look at what the expectations are for the next couple of years. So again, if they stay with earnings going to 7 cents this year, 49 cents next year, $1 in 2023. And you can see the continued solid growth in earnings, or excuse me, revenues from 170 to 210 to 270. That's a good study. And I believe unless the price has taken off pretty hard though.
Mark, throw the screen to me real quick, because what I've added to my graph here are the estimates from Morningstar going forward for the next 3 years. And it shows you how those estimates can lag behind real data without.
To grab it.
There we go. You'll notice that in 2021, the Morningstar is still down here on the graph, and they've already, greatly exceeded that value in the first 2 quarters of the year. And in fact, it doesn't look like there's much growth. That was at 6 cents, and this is at 7 cents. So this is pretty good growth, even the way they have it marked. But if this number comes in at a surprise, and it appears like it might have the possibility to do that, we might be really taken off with this company.
And it's already taken off. And the flip side of that coin is, again, for a company that's at the tipping point of going positive when it comes to earnings, if they fail and dip back below zero, that can be really painful.
Absolutely. Yep. Yeah. I'm going to put this one down on a list, because this one really has some interesting things in its little thumbnail too. Things that I don't quite understand. I'd like to understand a little bit better.
Yeah, so that's one that we'll certainly be kicking around in greater detail between now and Saturday. I think that the run-up in price is probably going to get in the way a little bit here, Ken.
Yep.
That's quite a zoom there.
And here's an example, Mark, where PE really is kind of meaningless. I mean, we're talking about pennies in the PE value, and still pennies, and these PEs in the 200s. I mean, any small company that I've ever looked at, when it moves into profitability, it takes them 2, 3, 4 years sometimes for the PEs to settle into some kind of range that's reasonable.
And of course, that was the subject of Brian's presentation completely.
Absolutely, yeah.
All right, we'll switch back to me so we can finish up.
Okay.
Now I have to remember where I was. Here we go. All right, so wrapping up with Brown, there's some companies there to study. Here's a reminder that we'll post this session along with all of the other sessions that we do, including the Successful Investing Conference, that are there for you to take a closer look at. Just a quick rundown on what's been going on. Some of these articles that are down here under the remarks and references are directly related to the stuff that we're doing this week. I want to encourage all of you. Ken and I will both be studying this Morningstar article very closely as we think about what's in our rearview mirror, what's in the windshield going forward for bank stocks, especially in a potentially inflationary environment. We want to understand that. So that's a good article for doing that. And I think that's all I wanted to point out on that slide. And just a quick reminder that we do have the Successful Investing 4 conference coming up. Ken, would you like to share your Master of Ceremonies?
Well, I'm really pleased that we've put together a stock panel that should bring you some really, really nice picks again. I mean, we have people that look at early stage investing and do a wonderful job of identifying those companies. We have people that look at classic up, straight, and parallel, and scope out some of the best buys that exist. And we have people that are looking under rocks sometimes and finding diamonds. So this is a great panel. Wonderful people, but also wonderful stock pickers.
In your slide deck, the actual presentations and registration information is provided. Those are all links under manifestinvesting.com/events also, if you want to take a look at it there.
that first class is going to talk about contests. We're going to dive into the Mid-Michigan Stock Pickers contest and look at the Groundhog contest and look at how you can use those contests for some great ideas and for some long-term investing discipline on your way to putting together great portfolios. If you have questions that you've been kind of worried about in your mind for a long time about investing or investment clubs, send them to Mark or myself. We're going to do a 20 questions a session in the afternoon on Wednesday from 4 to 5:30. And we'd love to have your questions that we can kind of bang around. You have 3 very experienced investors that can give you some insight into some of the history and some insight into some of the things that are happening right now. On Thursday, we're going to continue talking about small companies. We're not going to repeat what we're doing this coming Saturday, but there will be overlap. Sometimes I find that if you listen to the same general kind of material 2 or 3 times, you actually pick up more from it than if you just let it kind of process through your mind once. So that's a great 2 o'clock class on Thursday. And then 8 o'clock on Thursday, November 11th, Veterans Day, is the panel itself. We're going to try to stay disciplined and get finished with our hour and a half and give you some, in the process, give you 15 or 16 really good stocks to maybe investigate yourself.
Okay. Here's your weekly update on the Groundhog standings. The lead has narrowed. Barb Masters is in the audience. Congratulations on your position. Good luck, Barb. Just a number of very familiar names up at the top. The all-time leader in relative return in the Groundhog history, Hall of Fame, Sandy Castor, checks in there at number 10. Yeah, and Ken's got like 42 entries on here somewhere.
I do like to see that my family club has inched back into the top 40. That's nice.
Yeah,
still under the benchmark, but it's inched in there. Yeah.
Yeah, I thought about chopping that off at 39 just to keep your head from getting. All right, good stuff. Kathy Wood actually moved up a place, and we've done a little bit better this week. Every time we get up towards 10% on the return since last February, we've been crushed so far. So we'll see how we do this time around. So those are just there. We're just keeping notes. And then we'll close out with just a little reminiscing about 2 years ago and a cover slide from our round table. And we will be back at it this evening. I believe I didn't get a completely clear answer from Cy as to whether or not he was distracted to the point that he will not be there.
No, there was another email today, Mark. He'll be there, definitely.
Okay.
He even gave me the name of his stock.
Okay. I told him he had a permission slip signed by Braves management if he needed to miss it. But kind of interesting that he's wearing the Atlanta Braves jersey there from 2 years ago. I'm going to take credit for predicting that the World Series would be happening in Atlanta tonight. All right. So with that, I think we'll invite those of you. You're welcome to join us tonight for the roundtable. And again, our session will be on Saturday for the final selections. And we're at about an hour, so I think we'll just go ahead and close down the regular broadcast. We can stick around for a few questions and answers if there's interest, Ken.
Well, we've stayed pretty current on the questions, Mark, so we have nothing in the questions box, and I don't think we have any hands in the air. We don't, so we can say goodnight, and we hope to see you this evening.
Yep, see you later. Thanks, everybody.
Bye-bye.